So after all those other lectures that we went through, all the textbook lecture, this is really what I want you to take away. Like, this is the accounting 101, what I want you to memorize. And the 2 rules of accounting: debits equal credits and assets equal liabilities plus equity. I know I keep bringing that, and I think you're starting to realize how complex that is. It seems simple. You gotta memorize it, but debits and assets are both on the left side, credits and liabilities and equity on the right side. Some assets, all assets have a debit normal balance, credits decrease it, but then there's things like contra assets, like the accumulated depreciation you have to worry about. Liabilities are credit normal balance. You have accounts payable, notes payable, and equity you have to worry about calculating income, right? And so all of this, all of the rules of accounting can really be boiled into these 2 points, but it's more complex than it seems. And you have to memorize it. So when I'm saying debits equal credits, I use kind of this acronym here, but I feel like accounting, this will make it clear, but you're going to feel dead after you're done with accounting. That's kind of an internal joke for myself. But debits and credits. So dead is a mnemonic. Debits, normal balances, are expenses, assets, and dividends. These are increased with a debit. You can remember this by dead. You're going to feel dead when you're done with my lectures. But I'll make sure that this material is clear. CLE, it's kind of a stretch, R. So your credits are your liabilities, equity, and revenue. Those are the normal balances. Now you'll memorize it, right? Just remember, you're going to feel dead, but at least it's clear. Debits are your EAD, and then clear is liabilities, equity, revenue. There's not an A, but I think you get it. It's just so you can help remember. So this is like something you might get on a test. What's your practice problem? In a company's first year of the business, it had $25,000 in assets, $30,000 in expenses, 0 in dividends, $10,000 in liabilities, and $20,000 in equity. What is the company's revenue for the year, and is it a debit or credit? So how do we solve this? Any ideas? Just go with ideas. I want, like, let's talk. Go through your thought process with me. How would we go about solving this? Any thoughts?
I would say that maybe just draw a line and decide where the assets is going to fall on which side, and then where the expenses are going to fall, and then same with liabilities, dividends, and equity, and then calculate it that way.
Yeah, exactly. That's perfect. I think it's really helpful to talk through these problems out loud. And so that's exactly what we do. We just make an equation here. Perfect, Mina. So we figure out what our debits are. Our debits are expenses, our assets, and dividends, right? Dead, expenses, assets, and dividends. And clear, our liabilities and equity are our credit balance. And so we plug for our revenue, right? So what 55,000 minus 30,000 equals our revenue of 25,000. This is the kind of question you would have on a midterm question you'd have on your test. And so it might be 55,000, 30,000, 25,000, 25,000. The answer is 25,000 credit. So remember, revenue is always going to be a credit. You're not going to have a debit balance anyways. So a trick to do it, and I have a video too about, and I can go through it, taking tests. But the quickest way, the best way to take tests and to learn business and accounting is first you have to get your mind in a place where you think, what's the problem? You're always going to have these facts, and as you get more and more advanced, these facts could be pages long. We really have to ask ourselves, what's the problem? We're asking ourselves what the revenue is for the year. So that's the first thing I would do. And then the second thing, we can skip some of this. We know it's not going to be B or C because revenue is never going to be debit. And so now it's a true or false, pretty much an A or D question, just a calculation, right? And so knowing the material is going to help you get a little quicker at the that's how you're going to do your I'm going to give you a lot of multiple choice questions on your midterm. And so you're going to have to use these kind of conventions to think through it quickly. So that's the first piece. So assets equal liabilities plus equity. Thought here is what you have, this is the way I like thinking of it, is equal to what you owe and what you own. This is a little cleaner than the textbook. This is what are owned or controlled by the company is equal to that textbook definition is creditor's claim plus owner's claim. I think it's just what we have is the difference is equal to what we owe and what we own. What we own is our equity. What we owe is our liabilities. All that combined is what we have. So here's a list of all of the different types of accounts. Not all of them, but I mean, most of the ones that are important to you, your class. Cash, accounts receivable, supplies, inventory, notes receivable, PP&E, plant, property, and equipment. That's all our assets. Liabilities are going to be our payables, and then our equity we've talked about. Common stock, we can talk about preferred stock in the future, dividends, and retained earnings. And then what's important to remember, revenue minus expenses equals our net income. Revenue will increase equity, expenses decreases equity. Assets have a debit normal balance, liabilities and equity have a credit normal balance, but if they're reduced, like assets have contra assets, which will reduce it, which will have a credit balance. So some more practice problems. At the end of 2020, a company has $50,000 in assets, $30,000 in liabilities, and $10,000 in common stock. If the company issues $5,000 in dividends and has no retained earnings at the beginning of the period, what's the company's income or loss for the period? Another question, this textbook, what you get on a midterm. How would we solve for this? Talk out loud. Mina did a good job last time. How would you go about solving for this?
So you just have like separate columns for loss, incomes and losses, I think.
Yeah, I mean, separate columns is the right way to go. But instead of income or losses, we're trying to figure out the accounting equation. And so we know
right.
our assets equal liabilities plus equity. And so I'd make columns for each of those. You have your assets equal liabilities plus equity, and then start bucketing them off. So like this, we know our assets are 50,000. What's our liabilities and equity? Our liabilities is 30,000, and our equity is 15,000. I mean, our equity is 5,000, and so our liabilities plus equity is 35,000. So our difference is our income, because the income will increase equity to make this balance. Does that make sense? Cool. I can structure this in different ways. I could ask you, what's your liability, and take that away, right? Just make sure you understand this format and this structure and kind of do it yourself. So we had 15,000 in income. Other key takeaways from these previous chapters. Right? The accounting principles. I want to rehammer that home. The measurement principle or the cost principle. That's accounting information is based on cost. We're not worried about fair value. Revenue recognition principle is, I've kind of expanded it here for everyone. You recognize revenue when it's earned. It doesn't have to be cash. You don't have to receive cash to recognize revenue. And you measure revenue by the amount of the value you received. It could be in items as well. Expenses will be matched to the revenue they generate. And then we're required to disclose all information, non-cash information as well. So here's another kind of question for everyone. Which of the following statements would be false? This is another example, multiple choice question. A company must recognize expenses in the period where those expenses generate revenues. If a company purchases equipment for $10,000 that has a fair value of $15,000, it will record the equipment at $10,000. If a company has a significant pending lawsuit that would impact financial users' decisions, it would disclose the lawsuit on its financial statements, or revenue cannot be recognized before the company bills its customer and receives cash. So which one? Let's start with A. Is A true or false?
False.
A company must recognize expenses in the period where these expenses generate revenue.
False.
False?
False.
False. So that's going to be true. That is the expense recognition principle. We must recognize expenses when where those expenses generate revenue. And then that's complex, right? It's not cash out the door. It's when the expenses generate revenue. That's the example of the equipment, right? Or buying the house. We might buy the house today. It doesn't generate revenue today, so we don't expense it today. We have it as an asset on our books, and then we depreciate it over its useful life. Same thing with supplies. We might buy the supplies today, but we have to wait until they're used in order to expense it. It's good. No, I'm glad that we're battling with this. So next, does that make sense? Are we okay? Or if there's confusion there, it's okay. It's a few people, it seems, were a little confused on that, and I want to make sure. Okay. This is all new material for everyone, so it's fine to ask questions. Okay, if a company purchased equipment for $10,000 that has a fair value of $15,000, it will record the equipment at $10,000.
It's true.
True.
True, correct. Why? Which principle?
The purchase amount is going to be what's going to be recorded.
Exactly, that theory, correct. The theory of itself, the measurement or cost principle. We always are measuring it at cost, not what it's the fair value of it. Okay, if a company has significant pending lawsuit that would impact financial users' decision, it should disclose that lawsuit on its financial statements. Is that true or false?
True.
I think I got a few different ones there, but it's good. It's true, and it's because of the full disclosure principle. If we have significant information about something that investors should be aware of, we disclose it, even if it's non-financial. And then revenue cannot be recognized before the company bills its customers or receives cash. Is that true or false?
False.
False.
False. Why?
Because they could earn that money in the month, but they might not get paid for it until the end of the month or whatever the payment agreement is.
Revenue recognition.
Exactly. Perfect. And so that's here, right? This is what we just did is how you're going to get really good at accounting. Don't go through the multiple choices I give you and understand why they're, don't just go, oh, D for sure. I get it. We should go through all of them and use each one as a learning opportunity. This is actually 4 questions, right? And so you can match each one of these. Like A is actually related to the matching principle. B is related to the historic cost principle. C is related to the disclosure principle. And then D isn't correct because we recognize revenue when it's earned. It's not tied to cash. We learned so much from that one question. That's how you're going to get good at business in general, asking the right questions. Cool. Let's see. There's some accounting assumptions we can go over too. This is good. We went over the accounting principles, and now we'll go over the accounting assumptions. We have the 4 accounting assumptions we've talked about as going concern last time. Going concern means that we are assuming the business will continue to operate and not be sold. Monetary unit means that everything's happening in cash. Time period means that we can break periods out into years or months. And business entity means that the owner is separate from the company. So let's go through these. Which of the following is false regarding GAAP? A company is assumed to have an indefinite operating life. Is that true or false?
True.
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 Well,
And what principle is that?
Going concern.
Going concern?
Going concern. Perfect. Exactly. Journal entries cannot be non-monetary in units or time. True or false?
I think it's true.
False.
false.
Those are good. See, good debate. It's true. They have to be monetary. And a lot of times you're going to get double negatives. That's why I put this here, right? So we're saying it is always going to be monetary. It cannot be non-monetary. It's always going to be dollars. Good. A business owner's transactions are included with its entity's transactions. True or false?
False.
False.
Good job. From the business entity principle, we have them separate. Great. And then a company can report its information in monthly, quarterly, or yearly periods. Yep, true.
True.
So I think this is really what's driving it. And then I have these other ones, these entries, where we can practice our journal entries, the journal. So I went through this a little bit. We'll go through a few more entries. We'll go through one more entry, and then I'll leave it to Q&A afterwards. So let's talk about prepaid rent. So let's say my company, we rented an office that costs $600 a month and can be prepaid for 6 months for $3,000. So I get $600 off for paying cash up front. I'm prepaying that rent to receive the discount. So my question are, what are the journal entries? We have 2 journal entries here. We debit our prepaid rent and we credit cash on day 1, right? Because we're having an asset, we have the right to the prepaid rent, and then we'd reduce our cash. But then our rent expense, we'd amortize a month of the rent expense afterwards. What is this called? What's another example? If we're doing it at the end of the month, what is another name for this journal entry? What type of journal entry is this?
Adjustments?
Yeah, perfect. Adjustment. It's an adjusting entry. No cash. There's non-cash. And so we do it. The 500 is just the 3,000 divided by the 600 times 1 month. And so you see here, we only have expense for 1 month. So let's see how that we look at from a trial balance perspective, right? The trial balance perspective, we'd have debits of 3,500 and credits of 3,500. Our prepaid rent would be 3,000. Our rent expense would be 500. Our cash would be 3,000. Our prepaid rent would decrease 500. These are our credits. This is our debits. Debits, remember, are debt and clear. Assets and expenses. Credits are clear. They are both assets. Credits reduce the assets. So then we just use that information to make our financial statements. So this would increase our expenses by 500. And if you remember, we did a depreciation expense earlier, so it'd be 550 in our income statement. That 550 would go into our accumulated deficit. And then you see how this would be our balance sheet, our final financial statement. We'd have cash based on earlier on the transactions, our prepaid rent, and our net equipment, liabilities, and then our accumulated deficit would go here. And then you can kind of see how it would flow through a cash flow. Our payment here, our prepaid rent would go to 2,500, we paid, and then our income would adjust it. We'll go over cash flow more example later, but we have all these journal entries are all, with all explanations, are in this piece here. So you all have the accounting basics. If you go here, the journal entries 1, 2, so on and so forth. Let's see, journal entries. You can see all the journal entry videos. Number 1, journal entries number 2. I go through each one of them in detail. So you can kind of just rewind and practice until you get it. So I know there's a lot here. And so if we're in class, I'd go on the board and let you all practice in person, but we can't do that online, unfortunately. So what I would rather do, it'd be better for everyone if you want, you can go, I'm gonna stop recording this.